A business can generate strong sales and still struggle financially if its money is not planned properly. Revenue may look healthy, customers may keep buying, and the company may appear successful, yet cash can disappear surprisingly fast. In this masterclass, you will learn how to build a practical business budget from the ground up, forecast realistic revenue, plan expenses before they hit, manage cash reserves, prepare for slow sales months, and decide where your money should actually go. Number 1. Why business budgets fail. Imagine a small company expects annual revenue of $600,000. Management builds its expense budget around that number, hires another employee, increases marketing spending, and signs a larger office lease. 3 months later, sales are running 15% below expectations. Unfortunately, payroll, rent, software subscriptions, insurance, and loan payments are already committed. The budget looked profitable on paper, but reality created a completely different financial picture. This is one of the biggest reasons budgets fail. Businesses often begin with the amount they want to earn instead of the amount they can reasonably expect to earn based on customers, pricing, capacity, and historical performance. A realistic budget should separate assumptions from facts. Last year's sales are facts. Current customer contracts are facts. A possible large customer who has not signed anything is an assumption and should be treated differently. For example, suppose last year's monthly revenue averaged $40,000. Building next year's budget around $60,000 simply because management wants 50% growth creates unnecessary risk unless there is evidence supporting that increase. Expenses can create the same problem. Owners often remember major expenses such as payroll and rent while overlooking transaction fees, repairs, subscriptions, professional services, shipping, taxes, maintenance, refunds, and dozens of smaller costs. Timing also matters. A profitable sale does not automatically create immediate cash. A company might invoice a customer for $20,000 today, but receive payment 60 days later, while employees and suppliers need payment this month. A useful budget therefore needs realistic revenue assumptions, complete expense estimates, and an understanding of when cash actually enters and leaves the business. These 3 pieces should work together instead of being planned separately. The strongest budget is not the one showing the highest expected profit. It is the one that helps management make good decisions when actual business results are different from the original expectations. Number 2. Build a realistic revenue budget. Imagine a consulting business generated $400,000 last year. The owner wants to reach $600,000 next year, so $600,000 immediately becomes the revenue number in the new budget. That number is a goal, not yet a forecast. To turn it into a useful budget, the owner needs to determine exactly where those additional $200,000 of revenue could realistically come from. Start by breaking revenue into measurable drivers. Depending on the business, these could include number of customers, average purchase value, selling price, units sold, subscriptions, billable hours, locations, contracts, or repeat purchases. Suppose an online business expects 2,000 customers during the year with an average purchase of $150. Multiplying those numbers produces expected annual revenue of $300,000. Now, management can challenge each assumption. Can the company realistically attract 2,000 customers? Is $150 a normal purchase value? Does the company have enough inventory and operational capacity to serve those customers? Historical numbers provide another useful reference point. If the business served only 1,000 customers last year, doubling the customer count requires a clear reason, such as additional marketing, expanded distribution, new locations, or greater sales capacity. Revenue should also be planned by month whenever possible. A business earning $300,000 annually will rarely receive exactly $25,000 every month. Seasonality can create major differences throughout the year. For example, a retailer might generate much more revenue during holiday periods, while a tourism company could experience strong summer demand. Ignoring those patterns can make an annual budget look healthy, while individual months experience cash shortages. Create multiple revenue scenarios when uncertainty is high. A base case can represent reasonable expectations, a stronger case can show better than expected performance, and a weaker case can show what happens if sales disappoint. Revenue budgeting becomes useful when every important number has a business explanation behind it. Instead of asking, "How much do we want to make?" ask, "What specific activity must happen to produce this revenue?" Number 3, plan where every dollar goes. Imagine a business generates $50,000 in monthly revenue. The owner sees the bank balance growing and decides to spend $10,000 on new equipment because the company appears to have enough money. A week later, payroll, supplier invoices, rent, taxes, insurance, and loan payments become due. The $10,000 was technically available in the bank, but financially, much of that money already had another purpose. This is why budgeting should assign money before management spends it. Revenue first needs to support the costs required to operate the business, meet financial obligations, maintain liquidity, and eventually produce profit. Begin with fixed expenses. These are costs that generally remain relatively stable even when sales change. Examples include rent, salaried employees, insurance, software subscriptions, accounting fees, and certain loan payments. Next, identify variable expenses. These costs usually change with business activity. A retailer may spend more on inventory when sales increase, while a delivery company may experience higher fuel and packaging costs as order volume grows. Suppose a company earns $100 from a sale, but spends $40 producing and delivering that product. The entire $100 cannot be treated as available money because $40 supports the sale itself. Then consider expenses that occur less frequently. Annual insurance premiums, quarterly tax payments, equipment maintenance, license renewals, bonuses, and professional fees can create large cash requirements even though they do not appear every month. A practical budget can convert these irregular costs into monthly planning amounts. If an annual expense is $12,000, the business can effectively reserve $1,000 each month rather than facing an unexpected $12,000 cash requirement. Money should also be allocated toward reserves and future investments. A business that spends everything left after monthly expenses may have nothing available when equipment breaks, sales decline, or an attractive growth opportunity appears. Budgeting is ultimately about priorities. Every dollar cannot perform every job. Assigning money intentionally helps the business protect essential operations first, prepare for predictable obligations, build financial flexibility, and invest only when resources genuinely allow it. Number 4, predict expenses before they hit. Imagine a business normally spends $30,000 each month. The owner assumes that keeping slightly more than $30,000 available will comfortably cover upcoming expenses. Then several costs arrive together. An annual insurance premium becomes due, equipment needs repairs, a supplier raises prices, and a quarterly tax payment hits. Suddenly, the normal $30,000 month becomes a $45,000 month. The problem is not necessarily excessive spending. The problem is poor expense forecasting. Many business costs are predictable months before payment, but they feel unexpected because they were never included in the budget. Start by reviewing at least the previous 12 months of expenses. Look beyond major categories such as payroll and rent. Find recurring subscriptions, maintenance costs, professional fees, taxes, shipping, licenses, commissions, and other smaller expenses. Next, separate expenses by timing. Some costs occur every month, others quarterly, annually, seasonally, or only when specific business activities happen. This makes future cash requirements much easier to anticipate. For example, suppose a business knows that a $12,000 insurance payment arrives every December. Instead of treating December as an unusually expensive month, management can reserve $1,000 during each month of the year. Price increases should also be considered. If suppliers, landlords, software providers, or employees are likely to cost more next year, using today's exact expense numbers could make the future budget artificially optimistic. Businesses should also create room for uncertain expenses. Equipment may fail, customers may request refunds, shipping prices may increase, or professional services may be needed unexpectedly. A small contingency amount can protect the core budget. Good expense forecasting does not mean predicting every invoice perfectly. It means understanding normal costs, identifying large future obligations, allowing for reasonable increases, and reducing the number of financial surprises that can damage cash flow. Number 5. Build the right cash reserve. Imagine a profitable company normally generates $80,000 in monthly revenue. A major customer suddenly delays payment, reducing cash collections for several weeks, even though the company is still making sales. Payroll, rent, suppliers, insurance, and debt payments cannot simply wait. Without a cash reserve, the owner may need expensive short-term financing or may delay important payments despite operating a fundamentally healthy business. A cash reserve creates financial breathing room. It is money intentionally kept available for temporary revenue declines, delayed customer payments, unexpected expenses, emergencies, or other situations that the normal operating budget cannot comfortably absorb. The right reserve amount is different for every business. A company with predictable recurring revenue may require less protection than a seasonal company with volatile sales, expensive inventory, and large fixed monthly obligations. Start by calculating essential monthly expenses. Suppose the business must spend $40,000 each month to maintain basic operations. A 3-month operating reserve would represent approximately $120,000. However, 3 months should not automatically become the target for every company. Management should consider customer concentration, revenue stability, debt obligations, payment cycles, seasonality, industry risk, and access to additional financing. For example, a business receiving half of its revenue from one customer has greater concentration risk. Losing that customer could create a serious financial shock, so a larger reserve may provide valuable protection. The reserve should also be separated mentally and preferably operationally from normal spending money. Seeing a large bank balance can encourage unnecessary purchases unless management understands that part of the cash exists specifically for financial protection. A strong budget, therefore, does more than estimate income and expenses. It deliberately creates financial capacity for things that do not go according to plan, allowing management to make rational decisions instead of emergency decisions. Number 6. Prepare for bad sales months. Imagine a restaurant normally generates $100,000 in monthly sales. Management builds its budget, assuming that revenue will remain near that level throughout the year because recent performance has been strong. Then customer traffic drops and monthly revenue falls to $75,000. Food costs decline somewhat, but rent, management salaries, insurance, debt payments, and many other expenses remain almost unchanged. This is why a budget should answer an uncomfortable question before problems occur. What happens if revenue comes in significantly below expectations? Waiting for the decline to happen makes financial decisions much harder. Create a downside scenario alongside the normal budget. For example, calculate what happens if revenue falls by 10%, 20%, or another percentage that represents a realistic risk for your business. Then examine which expenses would change. Variable costs may fall naturally with lower sales, while fixed costs remain. Understanding this difference shows how quickly a revenue decline could damage profit and cash flow. Suppose monthly revenue falls by $20,000, but variable expenses decrease by only $7,000. The business still experiences a $13,000 negative impact before management takes any additional action. Now identify expenses that could be reduced quickly. Optional marketing experiments, unnecessary subscriptions, discretionary travel, delayed equipment purchases, overtime, or non-essential projects might provide flexibility without immediately damaging the core business. However, avoid cutting expenses blindly. Eliminating productive salespeople, essential marketing, customer service, or critical inventory could save cash temporarily while making the revenue problem even worse in future months. A downside budget creates a financial playbook before emotions enter the decision. Management knows which expenses are protected, which can be reduced, how long reserves can support operations, and when stronger action becomes necessary. Number 7. Cut, keep, or invest more. Imagine a company spends $5,000 monthly on 2 different marketing channels. The first generates $15,000 in profitable sales, while the second produces only $6,000 with weak customer retention. Reducing both budgets equally would be easy, but it would not be financially intelligent. The better decision may be cutting the weaker channel while protecting or even increasing investment in the stronger one. Every expense should therefore be evaluated by its purpose and economic impact. Some expenses keep the business operating, some protect against risk, some generate growth, and others may provide very little measurable value. Start by identifying essential expenses: rent, critical employees, core software, insurance, regulatory costs, necessary inventory, and important supplier relationships may be difficult to reduce without damaging the company's ability to operate. Next, examine discretionary spending, travel, unused subscriptions, excessive office expenses, low-priority projects, duplicate software, and poorly performing marketing campaigns are often easier places to find savings without weakening essential operations. Then, identify productive investments. Suppose spending $10,000 on equipment could increase monthly production capacity and generate several $1,000s of additional profit. Cutting that investment simply to reduce expenses could limit future growth. The same principle applies to employees. Hiring another salesperson increases payroll, but if that employee can consistently generate profitable new business, the additional expense may strengthen the budget rather than weaken it. Ask 3 questions about meaningful expenses. What does this spending accomplish? What happens if we remove it? What financial or operational return should we expect if we continue or increase it? Budget management is not about making every expense smaller. It is about moving limited resources away from low-value activities and toward operations, investments, and opportunities that produce stronger financial results. Number 8. Catch problems with budget variance. Imagine a business budgets $20,000 for monthly operating expenses, but the actual amount reaches $24,000. One month may not seem dangerous, but repeating that difference for an entire year creates a serious financial gap. The $4,000 difference is called a budget variance. A variance simply shows the difference between what the business expected to happen and what actually happened during a specific financial period. Not every variance is bad. Suppose monthly revenue was budgeted at $50,000, but actual revenue reached $58,000. That positive difference deserves investigation because management should understand what produced the stronger performance. Expense variances require the same attention. If shipping was budgeted at $5,000 but reached $7,000, determine whether prices increased, order volume grew, inefficient processes developed, or the original estimate was simply unrealistic. Look at percentages as well as dollar amounts. A $2,000 difference can be insignificant for a large expense category, but extremely important when the original budget for that category was only $3,000. For example, imagine marketing spending exceeds budget by 20% while customer acquisition costs decline and profitable sales increase significantly. The overspending may actually represent a productive investment rather than a financial problem. Now consider the opposite situation. Marketing spending remains perfectly within budget, but sales from those campaigns fall sharply. Staying within the spending limit does not automatically mean the business is using its money effectively. Review meaningful variances every month. Compare budgeted revenue, actual revenue, major expense categories, gross profit, operating profit, and cash flow. Investigate differences large enough to affect important business decisions. Budget variance analysis turns a static budget into a management system. Instead of discovering financial problems months later, owners can identify changing costs, weak revenue, inefficient spending, and inaccurate assumptions while there is still time to respond. Number 9. Adjust your budget as you grow. Imagine a company begins the year expecting $1 million in annual revenue. After several strong months, a new contract increases expected revenue substantially and requires additional employees, inventory, equipment, and working capital. Continuing to use the original budget would no longer make sense. The business has changed, so the financial plan must change with it. A budget should guide decisions, not prevent management from responding to reality. Growth affects more than revenue. Additional sales can increase inventory requirements, shipping costs, payment processing fees, commissions, customer support expenses, payroll, equipment usage, and the amount of cash tied up in daily operations. For example, a manufacturer may receive an order worth $200,000. That sounds excellent, but producing the order might require $80,000 of materials and labor before the customer pays anything. This creates an important budgeting lesson. Growth can consume cash before it produces cash. A rapidly growing company can therefore experience financial pressure even while its income statement shows increasing revenue and profit. Update important assumptions when conditions materially change. Revenue forecasts, hiring plans, supplier prices, marketing spending, debt payments, capital purchases, taxes, and cash requirements should reflect the business you are currently operating. Do not change the budget simply because one month performs differently. Temporary fluctuations happen. Adjustments become more useful when new information indicates that the original assumptions are no longer reasonable. A rolling forecast can help. Instead of reaching December with an outdated annual plan, regularly forecast the coming months using current sales performance, updated expenses, customer information, and known financial commitments. Growth becomes safer when the budget grows with the company. Management can see how much additional cash expansion requires when new spending becomes affordable, and whether increasing revenue is actually creating stronger financial performance. Number 10. Build your 12-month budget. Imagine you are planning the next 12 months for a business generating approximately $600,000 annually. Instead of starting with expenses, begin by mapping how the business is expected to operate month by month. Estimate revenue for each month using customer volume, pricing, contracts, sales capacity, seasonality, and historical results. Avoid dividing annual revenue equally across 12 months unless the business genuinely performs that consistently. Next, estimate direct costs associated with producing those sales. These might include inventory, materials, commissions, transaction fees, shipping, subcontractors, or other costs that increase as revenue increases. Then add operating expenses such as payroll, rent, insurance, software, professional services, utilities, marketing, maintenance, and administration. Include the timing of expenses instead of looking only at annual totals. Add major financial commitments separately. Equipment purchases, debt repayments, tax payments, expansion projects, hiring costs, and other large expenditures can significantly affect cash even when normal operating performance looks healthy. Now calculate expected monthly profit, but do not stop there. Estimate cash coming in and cash going out. Revenue earned during a month may not equal cash collected during that same month. For example, a company could report a $30,000 monthly profit while customer payments remain outstanding. If supplier and payroll payments are due immediately, the business could still experience a temporary cash shortage. Create a base scenario and at least one weaker scenario. Ask what happens if sales are lower, customers pay more slowly, supplier costs increase, or an important expense arrives earlier than expected. Finally, compare actual results with the budget every month and update future expectations when necessary. A 12-month budget should not sit untouched in a spreadsheet. It should continuously support spending, hiring, pricing, investment, and cash decisions. A strong business budget does not predict the future perfectly. It gives management a financial framework for making better decisions as the future unfolds. That is what turns budgeting from accounting work into practical business management. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.